Following on from their success in the South African listed property space, Stanlib have launched a global property fund to leverage their expertise into the global property environment. So will they succeed? By all accounts, it seems to be a case of so far so good. Fund manager Keelan Ndlovu joins us in studio to tell us how it's going. But before we go to Keelan, Warren, can you give us the lowdown at the moment?
Absolutely, Bronwyn. This is another fund that, and another competence within Stanlib that's been absolutely outstanding. And again, we talk about consistency here. If you look at the table next to me, you can see how this global real estate fund has performed against its peers in South Africa, being number one over 1, 3 and 5 years. So fantastic there. And just adding on to that, if we just roll to the next slide, you'll see that this consistent performance has actually been the result of a number of awards that that Stanlib have won. And Keelan Ndlovu takes control of both the South African listed space and now the Stanlib Global Property Fund. So we're going to ask him if he can compete with the big boys overseas now.
You obviously believe you can compete with the big boys overseas. Keelan, this is a new challenge. How are you feeling about it?
Sure, we're feeling good about it. And I must say as well, you don't have to be in London or New York to run a property fund. And we make it a point as well that we travel to all the continents every year to meet with these companies and also do site visits.
So you're still very focused on that on-the-ground presence, even now that you are going global? Definitely.
We apply the same model because at the end of the day, property is physical. You have to see what is happening.
So we do know that your family's never going to see you there.
It seems to be one of those things, Colin, where you've got to certainly put your feet on the ground and get around. So I'm sure you probably know most neighborhoods in South Africa, never mind some of the larger centers. But obviously we're talking about the Stanlib Global Property Fund today. I wanted to see, such distress in the Western markets. What's going on there? Are things on the back up and running again? Are banks lending? Are there opportunities for developments and inventory, to buy inventory?
Yes, banks are back in business. They're lending, particularly to big property companies. So funding is available at low costs, 2 to 3%. And these companies are buying properties at 6 up to 8% or 9% yields, which is yield enhancing. And if you look at the valuations as well, they've actually corrected positively after taking pain in 2008 and 2009. So it's looking a lot better than before.
I was looking at some of the forecasts, and you're saying you're expecting returns from this point out 10 to 12% in US dollars. Is that sustainable for a period of time, so beyond 1, 2 years, 3 years?
That's right, we believe so actually, because if you look at let's say the US, for example, there's not much construction going on at this stage, and as the economy is actually turn positive in terms of economic growth, there will be more employment, and more employment means more demand for space, and demand for space, it means higher rental growth and higher profits for these companies. So we like that there's actually not much construction going on at this stage, but we'll focus more on the bigger dominant counters with prime properties versus secondary properties.
Karen, just in terms of one of the things I just wanted to ask you about the way you conduct your business now offshore. Here you've got a limited amount of listed property stocks in which to invest. Yes. Overseas, I'd imagine you've got a couple thousand, if not a couple hundred at the very least.
Yes.
What's the sort of filter? How do you decide which ones to start looking at? Do you run financial filters, or do you just try and get out and see what's going on in some of these major geographies?
Sure. So we look at, we use sell-side research for most of the bottom-up modeling of property stocks, and then we consolidate those views and filter the properties in terms of yield, in terms of quality as well, and we look at the market movement and the valuations. So we do all the stock picking in-house, but rely on global peers actually on the ground in each of the regions.
Which regions right now are the most exciting? Because you would assume that in depressed or distressed environments you're going to pick up some bargains.
That's right.
Is that a theme you're following?
Yes, definitely. What we like is that actually the US is the biggest in our benchmark. We've got about over 50% exposure to the US at this stage. We liked Asia, we still like it, but actually Asia has actually done well over the last 2 years, almost back at where it was before the GFC levels, whereas the US is recovering. We've seen the economic numbers probably turning positive, ignore the last number, and especially quality properties around Manhattan, big dominant shopping centers. We had one of the companies, Simon Property Group, which is the biggest property company in the world. It's got a market cap 2 times bigger than the South African property sector. Positive numbers, lower vacancies in shopping centers, so we're actually excited about the US.
Just in terms of the US, we've heard Warren Buffett often talk about the ability of the US economy to start rapidly employing people and eat into that unemployment rate based on the recovery in the housing market.
Yes.
What's your sort of sense of the housing market in the US at this stage?
Actually, the residential property sector is about 11% of our fund, compared to the local space, which is less than 1%. We like residential because it's more defensive. Vacancies are lower. Not everybody can afford buying houses. People always rent, and we've seen those markets actually hold up better. So it's still positive on the housing market.
And besides just I guess the inventory that's been built already, how does it look? Is there wheels? Can you see developments being built when you travel to some of these places?
Yes, turning positive. So there is gaining traction at this stage, based on the positive growth in the GDP.
Now that you've got the offshore rather,
Yes.
property foray, what about the local property environment?
Yes.
Is there still money to be made in the local environment?
Sure. I always get this question whether should you go offshore, should you go local. I'll just give you different kind of valuation methodologies. You look at the yield and NAV valuation. So on a yield basis, the offshore market is looking more attractive, trading around 4% forward yield, compared to your bond market about 2%, 2.5%. And cash, which you're getting nothing out of it. Whereas in local space, you're trading at 7% yield, which is fairly in line with the bond market. So you're not getting a discount versus the bond market, and cash is about 4.5%, 5%. So global property scores better than local on a yield basis. And then we've got the NAV basis. The local market is trading at a premium to NAV of about 35 to 40%. So you're paying 40% more for physical properties. Whereas in the offshore space, it's trading in line with NAV. So you're not paying a premium at all. So on an NAV basis, looking cheaper as well. So we still like local property, but relatively speaking, offshore market is more attractive.
Is there a bit of a glut, Keelan, in terms of the amount of listed property counters that are coming to market at the moment? I mean, it looks like while the equity market had a great year last year,
Yes.
we've seen almost a mini listings boom in the listed property space.
Yes.
Is that a sign of a very bullish and toppish market?
Yeah, well,
Keelan doesn't want to think that it is.
I'll tell you why. Actually, being market leaders in this space as well, all these listed companies that have come through to the market, before you invest in them, we'll look at the assets, we'll look at the tenants, we'll look at the quality and sustainability of those properties. 2011, we had 16 billion come to the market. 2012, it was about 12 billion. So it's good for the sector, because the sector is growing now. It's over 200 billion market cap, and means more size, more choice, more liquidity as well. But not all the companies that wanted to list are listed. So we've turned down 1 or 2 companies.
Okay, and just in terms of the split, we talk about the split between industrial retail and commercial.
Yes, that's right, yes.
That's why I'm here.
Yes.
Everywhere I go, I see offices to let in Joburg
That's
and
right.
Pretoria.
Yes.
What's the sort of breakdown within those 3 sub-markets of the listed property space?
In the local space, retail is about 50%, offices 30%, and then industrial 20%.
And in terms of their prospects, are there different things? Because there seems like there's too much inventory in the office space, in the commercial space.
Specifically
that's got to
in the
work
B
off.
grade.
Definitely,
We've had this conversation.
no doubt. The office market hasn't recovered yet. Vacancies are still high relative to the retail sector and the industrial sector. So we like the industrial sector, number 1, because vacancies are low, 3 to 4%, and then followed by retail around about 6 to 7%, and the office market is over 10% vacant.
We've seen, Colin, and just to follow on from a question Bronwyn asked our previous guest, there's quite a lot happening in Africa. I know in Botswana, for instance, De Beers has relocated their head office, and many of the employees that were in London have moved to Gaborone. Are there opportunities for you in Africa at this point?
Sure, definitely.
And where are they specifically?
There's so many other places. We'll talk of Nigeria, we'll talk of Kenya, Tanzania, Zambia. We're actually looking to visit all these areas this year. And if you look at high-prop
if I can just jump in there,
sure.
will that constitute now another fund, perhaps an Africa-focused property fund?
Yes, I must say we've got an Africa property fund that we've launched already, and we're waiting for the market to grow in that space. So we only have Southern Africa exposure, like in Namibia, Botswana, Mauritius, Zambia. So we need to have West African exposure, Nigeria, and then East African exposure. So we already have a fund that we're working on and that we're running.